Hello, Warriors. Hi, Richard, Hugo. Hope everyone did well, did okay during the Fed action. Hello, Paul.
By the way, Dale, just good morning.
Yes.
Bank of England actually raised rates just now.
Okay.
The MPC vote, 8. Forecast was 9. Previous was 9. That is why the cable is getting smashed right now. So the cable is down because, you know, Ryan was just in the chat room. Ryan's not going to be here. He has to jump on a train. At least he's not jumping in front of a train. But
Good.
yeah, right. But he was just saying in the chat room how important the votes were. And it looked like there was one less that voted for a rate hike. So then now the cable is getting absolutely smashed. So and I hear, well, I see Kman here. If he wants to jump in and say something real quick, he's more than welcome to. I know Stelios just jumped in. I just had to say that really quick. So if you have any sterling longs, you have to be a little careful here. I have no pound exposure at the moment. So
good morning, everybody. Just on the BOE, they did 25. The vote was 8-1, and the 1 was Cunliffe voting for a hold. So it's a bit of a bearish hike there.
Bearish hike. Got it.
Okay.
It's actually all the lines yet.
Go ahead, Stel.
No, don't have much more to add. I'm just looking at the price action. I mean, I still think that Euro Pound is a nice. It seems to have bounced really strongly from those support below 83, and I think it's still going to be the trade for the next few months. I like that. Obviously, it will depend on the ECB as well, and the ECB with every opportunity is still relatively dovish, which is annoying. But if you're long this pair, but overall, yeah, the Bank of England was definitely less hawkish than expected, and they are still predicting 8% inflation for Q2. So that's that's on the high side. This is remember the Fed yesterday. Their projections are for higher inflation over 2023 than before. So it is going to be sticky, and their policy will theoretically have to adjust a little bit. But so far, the slight dovish reaction to the Bank of England and to the Fed from yesterday.
Yeah, and great point on EG. Everyone who missed that move, they're all waiting for deeper corrections, and if that's the worst it could do is 38%, that's a sign of strength, and not accommodating people who didn't buy it and are waiting to buy it until they chase, and then it'll be over. Looks like we could have at least, short term, looks like we'll go for that high up there at 84.60 or so. Any comment? Kman's here, so how about the yen yesterday, Kman? Acceleration.
Yeah, the spike after the F.A.C.E was like short-lived above 119, but we're still hanging in the high 118s. When we look at the yen crosses, they are still bid.
Yeah, yen's holding up much better than the 10-year yield. I mean, that was a pretty good pullback. It was a, buy the rumor, sell the fact, at least so far. Yeah. I looked at TLT. I think it's the most contrarian trade on the board, alongside of bonds.
Yeah, it's regarding especially the yen. I'm going to repeat it. We are in March, the end of the fiscal year, and there's a bit of a, if I can have like 30 seconds, there's a bit of a contrarian move, because normally flattening or a risk of inverting yield curve should be negative dollar yen. The yen should be really strengthening on the back of it. But then we heard that GPIF, the Japanese whales, were bidding dollar yen earlier, last week and earlier.
Yeah, I remember you telling us.
Sorry?
I remember you telling us. I remember because you used Japanese whale.
Yeah, exactly. And
do they eat sushi
today?
Japanese
overnight
whales?
It's Bank of Japan. Yeah, Bank of Japan coming up. My base case is they still hold off to do anything. Yeah, they will. If they do anything, I think it's going to be the first meeting in the new fiscal year, which is April, and they are meeting on the on the 28th of April. I've really marked that one with a big red mark. I think they might do something if inflation in the meantime holds up. And yeah, so the risk of inversion in the yield curve should be positive yen. But I think in the meantime, into the end of the fiscal year, since the hedging costs are higher, which reduces the value of their monster tanker US bond holdings, I think they might need to replenish a bit of dollars into the end of the month, and that may be mechanically underpinning dollar yen. That's what I wanted to say, really.
Okay, yeah, I mean, I don't think it turns bad until we're back inside the wedge. So, you know, I mean, there'll be warning signs prior, you know, like maybe 17, 18 and a half, 1840.
Yeah.
But, you know, what do you think of this? I know you do comment on SPOOs sometimes, Kman. Look at where we stopped.
Yeah, that's one, but I'm really having trouble to read S&P right now. Yesterday, the fact it rallied so hard, was the market expecting 50 BPs and they didn't do it? So is that the reason why S&P is rallied, because the market expected or some were hoping for 50 and then they had to buy back stocks? Really, it's tough to read for me, the S&P right now.
How about Euro? I mean, we're flirting with getting back, like I was talking about the yen being outside the wedge. We're trying to close back inside of the wedge. Here's a bigger picture on it in the Euro. Pretty nice week. The offer number was all the way down at 930. And, you know, we held that. That's the close from 2 weeks ago. It looks like a bottom to me.
That's good.
Buy it anywhere.
It's starting to get a big level down there at 109.30.
Yeah.
To be fair, on the back of, I was even long dollars. I was short euro dollar. Didn't have a really good day because I thought the Fed was giving what we wanted to hear. The more hikes, the QT decision
Kman,
possibly in May. So I was a bit wrong on that one.
Kman,
stabilizes.
Kman, can you hear me?
I hear you.
Hey, I was going to ask. I mean, and I talked about. I had this conversation with last night with Chris Weston from Pepperstone. But I want to ask you this. I mean, didn't we get everything we wanted and more? I mean, wasn't the Fed hawkish enough? I mean,
the Fed was. Harry Hindsight said the Fed was virtually as expected. So
who is that guy?
Harry Hindsight.
Yeah, he knows everything, you know.
As long as it's not just he has a Harry.
I think I've met that guy before.
You know,
I've seen him on Twitter. I've seen him in my chat room sometime. I know the Harry Hindsight guy. Yeah. Okay, go ahead.
Everything. Harry knows everything. So yeah, we got what we got what the market really probably was. The non-speculative side of the market is probably just getting what it wanted. Yields came off a little bit from the highs. Yield curve
was just positioning
even more. I don't know. I really don't know. I think euro dollar is in a range really. I can't buy euros. I mean, due to the Ukraine effect. Affected right now, and the effects in the aftermath. I still can't buy euros. Yeah, for the rest, I think the dollar. Nobody wants dollars right now. Huh? Cable was above 132. Aussie dollar, Kiwi dollar. It's all holding very, very, very well. We're still basically trading that Ukraine, right? And the possible aftermath of it's euro stable, and the rest Aussie, Kiwi very big.
I think it'd be pretty classic that the euro would bottom into a Russian invasion, because I think you got a lot of the holdout euro longs to capitulate, especially after we took out 110.
Yeah,
you know, to go to 108. I think the longs are gone. So, you know, every first rally is short covering, isn't it?
Yeah, well, we in the bigger picture, we can't forget what happened at 108, right? We had the acceleration, we broke through 110, we had the acceleration down to 108. It is a big level, and the bounce was spectacular. So if you only look at it technically, it's the end of a trend, right? When you do the acceleration and you bounce.
Right. Okay.
So
yeah, Aussie really outperforming everything as expressed, and Euro Aussie is coming off, but here we are back at resistance again too.
yeah.
So I'm not sure what to do with it. Gone to
The
head.
employment report was good, yeah.
Their employment
the Australian
report?
labor report was good.
Yeah.
Unemployment rate falls, participation rate higher, employment change a little bit better, full-time skyrocketing. So it's very good for the Aussie.
Okay. So we have some people in here long from 108. Nice, Mike. You're like, I have to interview you now.
Dale, one thing I want to say about the equities and the rally we're seeing post-Fed, I think was you who said it. I think the market was quite short. DSI was in the teens in the S&P, and it feels like it's a path of least resistance once again for equities to go higher. Now, I think any rally or any decent rally, I think is going to be a great opportunity to sell, especially if yields stay elevated. I mean, 10-year US is what, 213, 214 now. So we've broken 2% and we're going higher. I think I wouldn't be going against it right just now. I think there's an area with a couple of recent tops around 4,600 that if we get anywhere near there, I think that would be a nice place to short. But for the moment, it doesn't make too much sense. But I think the market is probably going to squeeze a little bit higher, especially if we get any kind of firm developments from Ukraine. That's definitely going to push it towards that 4,600 area. So
Stelios, I want to ask you, do you really believe all the positive stuff out of the Ukraine situation? I mean, do you really believe it? I mean, I'm asking for a friend.
Not yet, no.
Okay.
Everything's got denied this morning. By the
what's that, Kman? I'm sorry, I missed that.
Sorry?
I missed your comments.
Everything's got denied this morning.
Everything got denied. Okay, well, you know what?
And where are we? We're still higher than where we were before the Ukraine, in the S&P at least, which is a little bit scary. So if we haven't managed to sell off with the Fed being hawkish, with yields rising, and with the uncertainty of Ukraine still out there, if we haven't managed to sell off with all that, I think the best path of least resistance is still higher, and then we drop. But
they took a lot of longs out in the last 6 weeks. I mean, look at sentiment,
yes,
investors, intelligence, all of them. Everyone's saying the one thing that was missing was the capitulation type day where you had 90% down volume and things like that. But maybe that means that you're right. Still, we get this rally back to here. And Dale, if you're a believer in technical analysis and you think it's a wedge instead of a head and shoulders, you could be looking for new highs. But you know what the problem of this wedge is? And Blake will agree with me. It's not happening from a bottom. It's not these are reversal formations, so it's kind of acting more like
it's a pennant then.
Yeah, because I mean, wouldn't the wedge come in like after a big decline, a falling wedge?
Yeah, I mean, if I say a pennant, if I see a pennant like that, then that means it's more of a continuation pattern higher. Okay. So yeah, if you see a descending wedge into lows, then that is a straight up reversal pattern. You're right, Dale. That's exactly right. Yeah, I'm a little skeptical about this market in general. And if you don't mind, I'm going to take over the charts here. I was going to say I'm a little skeptical of the markets just in general because we've seen this big move down and we can look around. So let's just look at the NASDAQ here. NASDAQ, how far have we corrected off the highs? I mean, where we're currently at now versus where we went lows. We were down 22% off the highs. Now we're, down 17% off the highs. The S&P, the correction is not that much. And by the way, this is from yesterday because we broke that descending trend line. It was for our analysis for our traders. I'm looking to buy dips in risk now based on what had happened yesterday. But if you look at the S&P, just give you a quick view of the decline here. We're only 10% off the highs.
Yeah,
14%. On the full move down. The Dow, if we can clear this resistance, that's where it becomes bullish back to the 200-day moving average. But if you look at the Dow, we had a correction that was 13%, and we're currently only 8% off the highs. When you think about that, rates are moving higher. We've had an invasion of Ukraine into Russia. We've had commodity prices go through the roof, and we've got a Fed that is freaking tightening, and by the expectations of the markets are looking at 7 rate hikes going into 2022. So this is not only they're raising rates, they're going to be tightening monetary policy all through this year. And in the face of all that, markets are really holding up pretty well. So
the averages are.
The averages are, yes, there are individual names. It's like kind of looking at cryptos. You're like, oh, Bitcoin's holding up well. But if you look at some of the altcoins that have lost 70 or 80% of their value, then it's a different story. It's kind of something that we've talked about over the course of the last couple of years. But in cryptos, you want to stick with the bigger names because all the crap coins are going to be tossed away.
Our guest today, Sean Udall, says I'd add almost 50% of all NAS stocks are down 50% or more. So but again, you think about what the market is actually looking for here. The market's looking for companies that actually make money, right? Yeah.
And some of the bigger names. And then also on top of it, you have to imagine the whole Russia-Ukraine situation pushed people out of European equities into US equities. So now you got a little bit of a tailwind here if there is an improvement in risk appetite. I'm not saying that I'm looking to buy stocks and we're going to all-time highs, but I would say that the S&P, making it back to the 200-day moving average or maybe 4,600 is not a far cry from, it's not a huge ask in the market, if you will. So then the question you have to ask yourself is, how's the rest of the market going to respond to that? And, this is one of those things. And Stelios, I'd love to hear your comments here. And you too, Kman, as well. I had this conversation with Chris Weston last night on the trade-off. We were talking about, I posed the question about the commodity currencies. They are not acting the same way that they've acted over the last 20 years that I've been trading currencies predominantly. So I started trading, I went from day trading equities in the 90s to 2001, end of 2001, really kind of shifting gears to currencies more than anything else. And the one thing that I always relied on is risk off, sell Aussies. Risk on, buy Aussies. That was a pretty common, that's just a correlation you can really count on. If I felt like the stock market is going to get pounded, I just shorted the hell out of the Aussie and eventually work out, that type of thing. We've seen that dynamic really change over the last couple of, actually last several months. We've been talking about it since the beginning of the year, but it's really shown its true colors over the course of the last month. And, now if you're shorting the commodity currencies, you're going, well, this is not feeling so good, right? You got the Kiwi that's, really pushing higher, the Aussie too. You look at Norway won't break out to the upside where, in risk off, typically the dollar Norway would have been trading up at 10. And you can say the same thing for these emerging market currencies. So I guess my question to you guys is, if the market rallies, what do you think is going to happen to these commodity currencies that are already strong in the face of this pullback? I mean, if we do see equities, rally back a little bit, and what do you think? Any thoughts there?
Blake, I think that you're right. It used to be risk on, commodity currencies fly, and the opposite. The question is, though, what kind of risk off or risk on do we get? on this occasion, the risk off we're getting is, or we were getting, is on the back of what's happening in Ukraine. Look at commodity prices. Look at the countries like Norway or Australia and New Zealand. They're exporting dairy and meat and all sorts of stuff, right? This is the stuff they're exporting, and it's shooting up in value. I mean, it's commodities are going ballistic. So theoretically, this kind of risk off is helping them. Right? That's why I think we're seeing them not follow. The question now remains is, what kind of risk off or risk on do we get? Do we get if we get a reversal, or if we get actually Ukraine being resolved and commodities dropping back down, so the world does not is not panicked about supply anymore, then that could actually bring commodity currencies back lower. Which I know it's counterintuitive, but I think it's just the dynamics. So it's a very, very difficult thing to say. Oh yeah, risk on we buy commodity currencies, risk off we sell, because it's not the case anymore. I think it's short term though. In the long run, you're absolutely right. That's how it always used to work.
Yeah, it's interesting. It's going to be interesting to see how it works. And Mike made a good point here regarding the yen pairs, and that's something that if you guys remember back in the mid and early 2000s, I mean, the best trades were the yen carry trades. I mean, I used to just trade the yen basket as a basket. It's like, dollar yen's ripping, I'm buying the Aussie yen, Canadian yen. And then as a kind of a byproduct of the yen's rallying, yen pairs rallying, when everybody was selling yen, you'd be buying, like, for example, Aussies. And you can see the Aussie yen, the target I'm looking at is 91. All right. When the Aussie yen's breaking out, well, what happens with that? You get Aussie, cross rate movement, right? So you've got the Aussie dollar is just bid up based on the Aussie yen rallying, and then also you could say the Aussie is rallying against the sterling or the euro or whatever else. You can say just you're getting a cross rate effect, but these yen pairs are really, really breaking out. And I know Kman hit on it a little bit earlier, and my skepticism about the yen. I was long dollar yen yesterday afternoon. I was long, literally. We're almost where we're at right now, and I sold it on this move up in Asia, and then I don't have any dollar yen exposure right now, but I think that the dollar yen is probably going to consolidate here because of the sentiment of the yen is so extreme bearish right now that you have to be careful being long yen crosses or short yen, if you will. But that doesn't mean that they're not breaking out. They are breaking out. You just have to be careful, chasing them here. You got to be buying dips, if you will. But do you feel that any of this cross rate effect? Now, I'd like to hear from Kman here, who probably really remembers like all the yen movement that we used to see back in the early 2000s. Do you get a cross rate effect here, and is that really affecting currencies like some of the other majors? What do you think, Kman?
Yeah, and Stelios actually pointed at it completely correct. Everything, the commodities are flying, and so the risk parameters in the market have to be adapted. And then what I was saying before as well for the commodity currencies, it's a bit the far from my bed safety play as well. They are very far from the negative, the most negative action. So they are naturally underpinned. And as Stelios was saying as well, if the commodities come back down, it should be weighing on those commodity currencies. The only thing we will have to look at then is that, are they coming down because the world is not really in a better place, right? And we're going into recessions, or if growth holds up, then those commodity currencies could have one leg lower and then come back racing higher. But yeah, we in this situation we have to adapt the way we look at risk.
Yeah, and you're right. And we have to look at it differently. And I wonder if the dynamics have changed a little bit with these currencies. I was saying this last night, and I'm going to say it here because we have a little bit more. I have a little bit more time to talk about it. We did the 8 Cap Securities did a trading battle, and for the last like year, and I've gone up against. I did like the third one or the second one that they ever did, and then I did one after that, and then I just did one against Brent Donnelly, I guess, earlier this year. But at the end of last year, I got asked to do a quick, your top trade of 2022, and so I filmed a little thing, and I said, my top trade of 2022 is, I can't remember if I got asked this for which one got put in. It was either the dollar, I was looking for the to sell dollars on a rally, or what I really wanted to do is buy Aussie as it dropped to 70 cents, and I can't remember which one they ended up publishing. But in my head, I always thought, hey, the Aussie dollar, I feel, is going to go back to 100. We're going to go back and see parity. And I don't know I didn't know how we were going to do it, but I knew that this was a generational low. And if you look at what the Aussie is doing, like, this is longer term, guys. I want you to think about this over the course of the next couple of years, not necessarily what's going to happen right now. Here, we can do it like this. Like, look at this chart. I mean, just think about this for a second, right? This is where the Aussie was back in the 2000s. Crap. Hold on. There we go. So this is where the Aussie was back in the 2000s, right? And then we have this bump head, right? I mean, think about this. Like, this is like obviously 2022, and you see me drawing into 2025. But in my mind, I was always wondering, how in the hell is it going to happen where the Aussie goes back towards 100? But in my mind, I feel that that's what's going to be happening over the next several years. And, this shift that we're seeing, this really first inflationary shift we've seen in how many years, is really, truly here to stay. And those are the kind of things that keep me up at night. I don't know if it really should keep me up at night, but those are the kind of things I think about. Maybe I should think about, what the next Star Wars movie is going to be, So I don't know. Maybe something a little bit cheesier than the Aussie going to 100. I must have a problem. So anyway, those are just some things. Do you guys have anything else to comment? And really quick, for those people that are tuning in a little bit late, Stelios, Kman, Dale, you guys have any comments as the BOE? I mean, it was a pretty dovish hike right now. I actually bought some sterling on a cross just a moment ago, but
it just feels that the Bank of England put a lot more weight onto the potential deceleration of growth rather than inflation. Wow. And they did make Ryan put it on the chat room. I actually missed that. They did make a pretty significant change to the wording. They changed the wording that said they're going to be raising rates in the future, something like that, to may have to raise rates. I mean, that's pretty dovish. So to be fair, I didn't expect that, but hey, there you go.
And also they are hiking because of inflation, not because of economic growth.
Yeah.
I mean, if you hike with a 4 or 5% GDP behind you regularly year after year, you can hike because of growth, and the currency will strengthen. If you only hike because of inflation, then I don't see a big value in having the currency, right?
That's a good point.
It's just my opinion.
It's a valid one.
Sterling, because I don't really know what to do with it.
Yeah.
So our friend Sean says that inflation should be transitory. The problem is, are we going to be alive to see it when it drops? That's a thing.
Tony writes in, he goes, Blake thinks that the Aussie will skyrocket because he assumes the head and shoulder pattern will play out because of technical analysis. For that to happen, I think China needs to osmosis everything Australia can dig out of the ground. I don't necessarily believe that. Don't get me wrong here. It's not like I look at the Aussie and I'm like, oh, the Aussie is the only currency that's going to move. I actually think a lot of it's going to be a dollar play. Just so you know, in my head, I was wondering, how is the Aussie going to make this big move up towards 100? That also would correlate with the euro's probably heading back to the 130 level too. It's not just all Aussie all the time. You know what I mean? I think the Aussie, this is one of the reasons why you're going to be seeing the Aussie base against a lot of different currencies, is because the inflationary pressures that we have are not going to go away anytime soon. And I can guarantee you this, that the longer this Russia-Ukraine situation goes on, the longer these inflationary pressures are going to persist, right? So I just want you to say it's not the Aussie as a whole. It's the dollar really more that's going to move. I actually think that the euro is, should be bought down at these levels, even though I'm not long the euro at this moment. But you guys know I was buying the euro last week at 108. I just feel more biased to be long down at these levels, but it's scary to be long. What Kman said, it's really scary to be long the euro with what's happening in Russia and Ukraine. And I have a hard time doing that in light of it. So I share exactly what Kman's thoughts, what he said a little bit earlier. But hey, guys, I want to say, I know Dale's got a interview coming up. If you guys haven't checked out the Trader Funding Program, make sure you do so. If you guys want to figure out how to access larger amounts of money, that and trade our money, not your own money, and risk our money, not yours. You get paid out 75% once you reach a live trading account, and you have an unlimited time to pass your assessment. There is an assessment fee, but any other company that does, that offers, prop trading like this, they'll give you like, oh, you have 21 days to pass. You have 30 days to pass. No, for us, you have as much time as you need. And also you'll get ForexAnalytix Premium for a certain period of time based on the dollar amount that you choose to be inside of our community, inside of our chat rooms, and get ideas from the like, here's the trade room where you can actually see, what trades people are actually trading. And some people talk about them in the general chat room as well, but you can see how active this community is. And, why try to do this on your own? This is just from this morning over the last 2 hours. You can see this is basically when I got up this morning. So you can see how active our community is just over the last hour and a half of chatting. And that's just in the general chat room, not any other room. So again, if you want to try if you want to check out the Trader Funding Program, make sure you do that. There's a video right at the very bottom here. So check it out. I'll put the link in. This is the link that you guys can just view that. I'll put it in the chat box so you guys know exactly where to find it. And I want to say, everybody, have a great trading session. Thanks everybody for joining us. Kman, really appreciate your comments this morning. I know Ryan couldn't be here today, and Stelios, always appreciate you being here. And I know Steve is busy working on our annual event coming up. And Dale, you're always, great for being here as always the best host.
Well, you know what, your analysis of Aussie, I had to crack open a Forster's, and I'm watching an Olivia Newton-John movie right now.
Hey,
I know you had a crush on her.
Just so you know, we have nicknames for our currency pairs. Yeah, a lot of them in our chat rooms. Like, we call like the dollar Mexican peso Salma for Salma Hayek. Yeah. Do you know what we call the Aussie Kiwi?
No.
Kylie Minogue. She's Kylie. This is Kylie. So anyway, all right.
One hit wonder.
What's that?
Kylie Minogue, one hit wonder, right? Although
she can one hit wonder all day long. I'll just watch her early 2000s videos all day long.
Couldn't agree more.
All right.
That
anyway,
must be
have
Sean.
A great interview.
All right. Thank you, Blake. Thank you, team.
Guys.
Thanks, Kman.
Cheers, Dale.
Thanks, Stel.
Have a great interview.
Okay, Sean, welcome to F.A.C.E. Nice to meet you.
Hey, Dale. Thanks for having me.
Yeah, you ever drink decaf? Anyway, I could tell you have a lot to. Yeah, I could tell you have a lot to say, and you could go ahead and share your screen if you want. I know you want to talk about the markets here, but before, you see the little green button down there.
I do. I don't know if I have. I could. I don't know if I have a ton to. I don't necessarily have a ton of prepared charts. We can talk about whatever you want. We can look at each other's faces if you want. I'll just
share.
We can leave it.
I'll share mine.
If you would just want to share and just pull up.
I'll scroll around.
Yeah, pull up whatever chart we're talking about.
Okay. So before we get, I've been on these rodeos. So, Why don't we start with your journey and what were you doing before you got into the business, and what was like your first gig?
Well, first of all, it's interesting talking to folks who are focusing a lot on Forex, right? So one of my first jobs post college was with Visa, which I'm sure you guys all know who Visa is, Visa MasterCard. So that was when Visa was a private company, a very large private company. And I was actually in the Treasury Department. One of my functions was, hedging, managing, transacting currencies. And that world is a lot different. There were a lot more currencies then. There were a lot more active currencies. So that was pre-Euro. And so that's actually kind of what got me into. Now, I had read a lot of, now don't even ask me how this happened, but I'd probably started reading the Warren Buffett letters probably from around 8th grade freshman year. So I was kind of learning and interested in value investing from a pretty early age relative to most people.
High school.
And I had probably read, like, up to that day, like I'd probably read 90% of the Berkshire letters. And that, by the way, that's what I call them. Now they'd be called the Berkshire Hathaway annual reports. And I would say the best letters were sort of his very early ones, late 60s to probably, I don't know, late 80s. Honestly, once it got kind of into mid 90s, the letters weren't as good, frankly, because it really became a really heavy focus on insurance and float. And that's still super good information. But anyway, so I was pre-med. I decided to go finance econ. Long story short, worked for Visa for a few years. And then I went to work for Verifone. Verifone was a publicly traded company. And then I got into the finance field post Verifone. So I was at Morgan Stanley for a while. And then my last stint kind of for a big company before I basically pretty much been trading full time since 2011. My last stint was with State Farm, another really large private company. And I was in sort of the upper ranks of enterprise risk management functions there. So that was pretty much everything to do with, managing risks, looking at risks, developing programs. A lot of that had to do with a very large equity and bond program. And then, I'd been trading for a number of years before that. And it kind of just morphed into a full-time trading job. And I've been publishing. So I'm the founder and I author a subscription called the Udall Report. There's not much to look at on the website. It's a private Twitter feed mostly. I'm probably going to transition that to something like a Slack room in a few months. So you're showing my Twitter profile. That's my public profile. I'd say most of my work on Twitter the last few years, last 3-4 years, has been in my private feed. I'm probably going to re-engage on the public side again. But so basically what I do now, I've pretty much been analyzing tech stocks as essentially full time since 2009 to 11 and since. And if you want to trade and invest in tech stocks, the one thing you learn very quickly, if you want to survive, is you also have to have a lot of market awareness. And so I would say my currency background actually helped me a lot. So if you guys want to end up talking about S&P, NASDAQ, and then how many stocks actually don't reflect the indices at all. But so you kind of have to learn to survive. You have to say, you can't just say, hey, I've got a great stock. I've got the next Apple. I can trade it. I can own it and become a multimillionaire. You're going to get blown up. If you don't know how to manage risk and you don't have some market awareness, you can be in the greatest stock in the world.
How do you manage risk, Sean?
God, there's a bunch of ways. The most basic thing I would say for people, I'm not a huge position by position stop loss believer. I think when you're learning, you should probably do that. I much more believe much more effective stop loss strategy is a portfolio stop loss strategy. And the more advanced you get,
what's the difference?
Well, I think one, it's just far more. If you basically say whatever let's say you start with 100K. Okay.
Yeah.
Let's say you have a spectacular meme run, right? Or a spectacular run where you double or triple or quadruple your account, then you can say, hey, from here, I'm going to tolerate a certain drawdown from here. So let's say if you say it's a 5% drawdown, you're going to probably sell your whole account out every other day. So, but if you say, hey, I've doubled up or tripled up, maybe 25%, 20%, 50, whatever.
Well, what if you have no profits and I'm giving you 100K today? How would you manage the risk?
Yeah, I think you have to use probably three things. You have to use a blend. I almost think you could kind of do the same thing. You're not going to put all that money to work in one day, hopefully. Two, I do think you probably have some position limits and some individual risk metrics, meaning individual stops and things like that. But I still think you could basically use that same approach. You could say, hey, if I'm down 15, 20% on this 100K, I've got to reassess things, right? But I really do. I think that's more effective because if you're putting a loss on every single or a stop on every single trade, what you're basically doing, we could get into algos because that's what I've really become.
Yeah, they'll take you out on stop.
They will. They'll basically take you out of every single trade effectively, right?
Okay.
So, but I really do. I think in fact, one of the best tips I could give to new traders is learn about a portfolio stop loss strategy as opposed to an individual position stop loss strategy.
Okay. Yeah, I think that makes sense too. So I'm getting from what your comments were prior to the interview, you said everyone who had to get out is out. And, I noticed these divergences here the other day. What's your view on NASDAQ here? Where are we going?
Well, so here's my view on NASDAQ in 3 bullet points. One, I would compare the NASDAQ versus something like the IWM or the IWO. So one, I would compare it versus other things. Two, I would compare it versus how many stocks are down anything like the NASDAQ. I mean, I'm in a bunch of stocks right now that look nothing like the NASDAQ because I like kind of smaller to mid cap. Now, mid cap now can be as much as 20, 30 billion bucks, but I used to own Apple. I don't own Apple anymore, right? I used to own Facebook. I'm not interested in those names anymore. But I would say as far as just the chart of the NASDAQ, at least it's a little more reflective of the underlying damage because one of your other guys said it was down 23% at the max off of highs. That's at least somewhat more reflective of what's really going on in the real world, if you will. The one thing I'm going to transition and talk about the S&P for just 3 seconds. The S&P is like just in a land of its own. There's no index that's down this little. The IWM I think was down like 25 to 27%. The IWO was probably down 30 some percent.
You think there's a pairs trade like being long the Russell IWM against NASDAQ?
Yes, I was just going to mention that one of my big themes is, in fact, if you were to pull up an IWM versus QQQ ratio chart, that chart has literally been going down since the fourth quarter of 2007. Now, just think about that.
Yeah.
Now, the fourth quarter of 2007 to now is 15 years. So put it this way, there were some people who wanted me to call a bottom in December, January. I'm like, no way, right? And just to give you some background, I was raising cash in October, November, I was cash. Now, did I raise as much as I wish I would have? No way. I wish I would have raised 2 to 3 times. At least I was raising cash at a good time. But the one thing I was looking at is like at the end of last year is, man, look at how cheap just these, let alone individual small and mid cap growth stocks are, but how cheap even just the index like the IWM is relative to every other index on the planet. Now, the US indices, I'm not as expert. I don't think the DAX, for example, has gone up near what the NASDAQ has gone up since the COVID lows, probably not even close. Yeah. So, we're talking about certain indices that obviously had an overshoot phase. But looking at longer out, I would say there's almost no way that something like the IWM doesn't have very meaningful performance versus something like the S&P. Like, I literally don't know, Dale, how the S&P is only down 10%. I think the max drawdown in this cycle is minus 12.8%. or something, maybe 13. Yeah. And that was an intraday low, which I think we bounced 4% off of that day. So it's just really, really strange. It's a really, like, the comparison period I've been using to now is 2016. The damage to most stocks now is much greater than 2016, but it was the same kind of market. The S&P held up pretty well. NASDAQ was quite a bit worse, but there were a lot, like the whole biotech, biotech index was down 67% from top to bottom. I'm trying to think, there was another index that was down huge. Like if you take out mega cap tech stocks back then, like the average, it was kind of like now. There was a huge percentage of NASDAQ stocks that were down 50 to 60%. Right. So, like, I don't think people are aware of this. I'm not joking when I say 50% of the NASDAQ is down 50% or more. That's really accurate. It's probably like 46 or 47% of the entire NASDAQ is down more than 50%. That, just so you know, that's only ever occurred in full-blown crashes. So it's very, like, so outside of the S&P, you basically have a market crash that nobody's talking about. So
you feel that way about that way about semis too?
No, it depends on the semi, right? So
well, like SMH looks pretty good.
It looks better. What you tell me? The SMH is probably down a little bit more than the NASDAQ. SMH probably did minus 25. So at least that's a little more reflective. But look at, like, a stock like Intel is one of my favorite semis right now. And there isn't a person in the world that likes Intel. So
because it's an old name, right?
Probably because it's an old name, but I think more because of sort of everybody now is kind of geared into recency bias and momentum and what's working now. And you know, I think everybody's going to get taught a big lesson, actually. I think the chasing of performance and the chasing of momentum, I don't think has ever been more popular than it has been really in the last 18 months.
Okay, especially in the commodity complex. And another comment you made during our analysis was you're the only one left that believes inflation can be transitory. So
sure,
tell us about that and why you think it is.
Well, I think the best way to sort of express that, now, this is probably going to be the most disagreed with comment I make in this whole interview with you. I actually think
I think there's going to be a breather.
Oh,
at least. Go ahead.
A breather meaning?
Sharp corrections.
Oh,
another wave up.
For sure. In fact,
in commodities.
Yes. Okay. So, but
it's already started in crude.
I actually think the Fed had it right when they said inflation was transitory. Now we can make fun of the Fed and say how wrong they were and how late they were in raising rates and things like that. They're very behind the curve, obviously. But I really do think.
We're not saying it. Jay Powell is saying it now.
Okay. Well, there's lots of people who would the popular opinion, I think the popular media opinion would be that the Fed's
behind the curve. Right.
Exactly. Okay. So let's talk about commodities and inflation. If we didn't have the COVID crisis and people not showing up for work, people not working, ships not being unloaded, et cetera, would we have much inflation right now? I would say, well, there's always some. And inflation is almost always kind of understated, right? That's the argument from some people is like, well, inflation is not measured correctly, blah, blah, blah. But you have to take things as they are, right? But the inflation numbers as they are largely a function of COVID, supply chain, all these things that frankly have nothing to do with the interest rate curve. They just don't. And then the Ukraine war was almost like the Ukraine invasion was sort of like the final cap on top of things that made inflation even worse than it was already, right? So you just mentioned oil. Wouldn't you think oil should have held better? I mean, what is it? $30 off of highs already?
Yeah, I think we're going to 85, 80.
Yeah, we might even go back to 65, 75. I mean, let's say there's a resolution to Ukraine relatively soon. By the way, I don't expect that, but let's say there is. At that point, I don't know. Is there really that much oil usage that the world can't handle? And so anyway, and we could talk. I mean, lumber has had this massive move. The one part of inflation that the Fed might be able to do something with would be like housing. I think the Fed is afraid
stocks.
of. Yeah, and absolutely.
But I mean, how can the Fed create more corn? They can't print it.
They can't create more lumber.
How do higher interest rates reduce? Is it going to be demand destruction? And people are saying, well, it's not going to be I don't want to eat. It's going to be I can't afford to eat.
That's right. So if you, first of all, if you believe the Fed, if you believe that they're actually going to be able to raise 25 times.
I don't. I play Johnny Lang's song, "Lie to Me." Check it out,
so,
man.
But I mean, they're what are they calling for? 25 hikes? I'm sort of exaggerating, but it's almost like what they're saying. They're going to hike 25 times now. So, but here's the one thing the Fed, I think, has done effectively. What's one of those powerful tools of the Fed? It's called jawboning. Jawboning is talking about lots of things, and the more effective they are at it, the less they might have to do. Like, do you really think the Fed really wants to take rates to 2 or 3 or 4% in a world where there's so much debt that they're going to have to refi? You think they want to refi a bunch of US paper at 4%? I mean, come on. So, but that's another topic. But I think if you don't get, if you just get, let's say, half of the COVID stuff taken care of, I think roughly half of the inflation numbers probably go away. Now, that doesn't mean we're going to go back to sub 2%, but I think you get down. I think the realistic inflation is probably down more closer to 4 to 5. So there's like 3 things. But by the way, if you're, I'm sure you pay attention to this. How many economic data points are showing strength anymore? Like the Empire Index 2 months in a row has been negative. And like massively missing expectations. So I think what's going to happen with inflation is basically going to take care of itself, because the seeds of inflation's downfall were already in the system before the Fed made the hawkish pivot.
So would you short gold and silver in the minus?
I actually said when oil was around 125 and climbing, I said I thought energy stocks were a good short-term short. Gold's tough for me because it's not a central part of what I do. I do think maybe in 3 months or something, I would start thinking about something like that. For me, I'm probably not going to do that. Here's the differential. So I don't look at gold as much as I used to, but I do look at the commodities. I would say, would you rather buy a tech stock trading at 1.5 or 2 times sales or 3 times net cash, which with lower growth has 15 to 20% growth versus, let's say, 30 or 40 or plus? So would you rather buy a tech stock with 15, 17, 18% growth trading 2-4 times cash, or would you rather try to short gold? So that's my world, right? Because I know tech stocks and I know lots of stocks.
Right.
One thing I might add would be, I think everybody's going to go crazy on finance stocks, and they kind of have. So this is something I more directly know. So this comes from, I was buying finance stocks in 2009 and 10. I was selling them 15, 16. I was buying finance stocks post-COVID. I sold them all October, November, December. Most of that was sold December. Everybody seems to love finance stock. You could pull up the KRE. That's the regional bank index. You could pull up JP Morgan. I don't know, whatever. But
yeah, they're all getting hammered. Do you think there's systemic risks from what we did with sanctions? And are you worried about the Russians defaulting?
No, what I'm worried about is if there's any truth to But what I'm what I'm worried about is if there's any truth to the Fed raising that much, you're the worst sector to be in if there's a whiff of a recession is the bank stocks. Mm-hmm. I mean, if you can just go look any time we've had a recessionary pulse, even when we don't hit a recession, but we kind of people think we might, at some point the bank stocks become the worst stocks to be in. So that's more why I sold all my bank stocks. So now systemic risk, I actually don't think that's much of a factor for US banks. My guess is, and I've looked at the Eurostoxx bank index, I think it was down 25 to 35% in about a 2-week period of time as of like last Friday. So I don't know if I could put money in any European bank. I think European banks might have a fair amount of systemic risk. The US banks are pretty, like the Citibank had a report. They have something like less than 0.8% of their total book has exposure to, for example, Russia. That's super minimal exposure. So I think the US banks are, I don't know if they were mandated to not lend, but they just don't have hardly any exposure to that part of the world. So, but I just think it's a bad place to be on a relative risk. On a risk reward basis, I think bank stocks are a bad place to be. And that's where what everybody's rushing into. And that's what everybody thinks the trade is now on higher interest rates.
Okay, so bear market rally in S&Ps or new highs?
That's kind of what I think. I think you're going to have a hard time. I almost think S&P has to catch up to the broad damage that, again, you basically have outside of the S&P, pretty much you can almost say anything with a market cap less than 50 billion, which is still pretty big, is basically in a crash. So, I think the rest of the world kind of has to catch up, or the S&P has to kind of catch up to the rest of the world. So I wouldn't be a bit surprised. Are you old enough to remember 08 and 09?
Yeah.
Okay, so stocks bottomed well before March of 09. The S&P put the mark of the beast bottom in March of 09. But most stocks, especially the tech sector, probably bottomed 4 to 7 months. I'm going to say, maybe let's just use 6 months, give or take a month or two. So what happened is a lot of stuff started working higher. A lot of stuff at least started holding. And then what happened is you basically had one last kind of worry on the finance sector. The powers that be realized that an accounting rule was causing more damage than anything they could fix. So they basically repealed FAS 157. People could go look that up. FAS 157 was mark-to-market accounting. And that was, in my view, a much bigger reason for the financial crisis than, people buying 5 condos in Florida.
Yeah.
So
you think real estate could get hammered again?
I think real estate is the next shoe to drop. I don't know. It's tough to say. Is it like, are we going to go into an 08 period? I actually don't think so. But I think stocks are acting like it. The average stock is acting like it's pricing in a recession. So back to the whole rally, right? Back to why did we rally so much off the Fed meeting? I think like everybody that was forced to sell had sold at least short term. I think the average stock has actually priced in or more than priced in a recession. Nvidia, I don't think is priced in a recession. I don't think Snowflake has priced in. Even Snowflake is down a ton. But these are these very high, high multiple stocks. Yeah. But I think the average stock has likely priced in a recession. So now we're going to be on recession watch, I think, for the next 4 to 8 months. So my guess is, as other stocks don't go lower, if we do start having more recessionary pulses, I think the next 3 months, you're going to have a lot of economic data that's not nearly as rosy as the Fed says it's going to be. And then I think there's a lot, what is really carried the S&P in effect? There is a lot of tech in the S&P today, but there's still a lot of finance. There's still a lot of energy. So you got finance and energy is basically supporting the S&P. So if oil goes down and the energy sector goes down, and then bank stocks go down, there's not very much underpinnings on the S&P anymore.
Okay, so you're bearish here.
I'm bearish on the S&P. I'm probably neutral to getting bullish on small and mid cap growth stocks.
Okay. All right. Well, we have to wrap it here, Sean. I appreciate your time. Best way for people to reach you is on your Twitter handle.
Yeah, just use the Twitter handle, and then what usually happens is I start, people use Twitter, they follow me. Again, I'll probably get more active on it, and then but through that they can DM me or whatever, and then if anybody's interested in my subscription, they can contact me through that. But it's been great. Okay. Again, I wanted to thank you because very rare, very refreshing to hear lots of currency talk, because hey, you can learn a lot from it. I probably will. You can learn a lot from it, and it does have a lot to do with what's going on in the world.
Sure does. The world revolves around the dollar.
It does. It does. By the way, before I go, is the dollar reflecting all these rate hikes yet? These supposed rate hikes?
I think the dollar is peaking out here.
See, that's very anti to if the dollar believes that the Fed's going to hike 25 times again. Okay, 12 times. I would think the dollar would be ripping versus every currency on the planet. Wouldn't that be the expected move?
Well, it depends what the rest of the central banks do.
That's true.
And there's other factors besides interest rate differentials.
Well, yes, yeah.
So
yeah.
So I think the euro is bottomed.
Interesting. So you like the euro? You think the dollar's peaking, and you basically don't think the Fed's going to do as much, and the euro economies will basically survive the Ukraine invasion. Is that kind of your base case?
Yeah.
Yeah. Okay. Well, hey, thanks again for having me. You want to have me on? I appreciate the invite.
All right. Well, thank you, Sean. So Sean Udall, everybody, could follow him at Udall Tech Strat.
You got it.
Okay.
Take care, everybody.
All right. Good hunting. You've survived an interview with me, Sean. You know what that makes you?
Tell me.
My trading warrior brother.
Hey, I like it. All
right, buddy. You're in the club.
Later. All right, later.
All right, everyone. Remember, don't just count your pips, count your blessings. I'll see you tomorrow. I have a interview with Rohit from at India Charts, which one of you guys requested. I bring him back, so he'll be with us tomorrow. Happy Purim, Amira. Happy Purim. Go grab an apple for me. And that's going to be a wrap. See everyone tomorrow. Join the team in 14 minutes on the Morning Edge and get sharp. Adios. You're welcome, Mark, Monica.